Welcome to Smart Money Simplified with Brent Mekosh from the Wealth Stewards. In this podcast, Brent discusses some of the most important and interesting topics of the day as they relate to finance, the economy, and beyond. Now, on to the show.
Hello, and welcome to the Smart Money Simplified podcast, hosted by Brent Mekosh. Brent, good to be with you. Good to see you again.
Well, Bill, for those of us that are listening to this, it'll be about a week or two from now, but today is actually Valentine's Day. It's February 14th, 2025, as we're recording this. And, I've got a date with my wife this afternoon for Valentine's Day, but I got to tell you, Bill, I'm happy to be spending this day with you as well.
Well, thanks so much. I thought about bringing one of those little candy hearts on that said "Be Mine," but we probably would be overdoing it.
It might be, but no, it's great to see you today, and I'm looking forward, as I always do. I'm looking forward to our weekly discussions that we have here.
Yeah, I'm really looking forward to this one in particular because, as you mentioned, it's still early in 2025. But there are a lot of things on the table. For those of you who are not paying attention to the news, there is a lot of change already occurring in 2025. I don't think it's going to slow down. In fact, there are some things we know for certain have to happen this year. So I'm curious what you have to talk to your clients, my friend. You have to sit down and either assure them, reassure them, or at least give them your best guess on what's going to happen and how maybe they can deal with it. So what's going on and what are you telling clients?
Yeah, that's always the challenge with this business is everybody wants a prediction or where's this index going to start the year and end the year. And we do tell clients that every single year, all the financial publications and all the research guys from Goldman and Morgan, and I'm not picking on those two companies, from pretty much everyone, will come up with some estimate of where they think the S&P is going to land at the end of the year, where they think interest rates are going to land, what they think about pretty much every conceivable market. And none of them are ever right. And some of them are massively wrong. And that's not because they're not smart people, because many of them are extremely intelligent. But the world, particularly the financial markets, it's so dynamic that things often veer off in ways that we don't fully expect, obviously, in the start of the year. But one of the things that we have had, though, and we put together our three themes for 2025 in the tail end in the fourth quarter of 2024. And it's been interesting to watch this year unfold because some of the themes that we were focusing on, granted, we're midway through February. It's still very early, but it's starting to look like it's going in at least in the direction that we thought. So it's been interesting to watch the year unfold so far.
So what are you looking at in particular?
The themes that we're discussing with clients is these ideas of fragility, durability, and then what we refer to as the age of alpha. And fragility is really that there's a lot of risk that's underneath the surface that we really haven't seen in the financial markets pretty much ever. I mean, if you've been an investor, pretty much the only game in town since the financial crisis has been the S&P 500. As an asset class, large cap U.S. stocks, specifically growth stocks, have just crushed everything. But it's been a very small handful of names. So the concentration of that performance within the S&P 500, we quite frankly have never seen anything like it. And when I talk about concentration, what I mean is back in the last real peak that you had in a growth equity cycle was around the year 2000, and you had technology was maybe 25% or so of the S&P 500. Now it's over 40% of the S&P 500. The top 10 stocks in the S&P 500 make up now over 40% of the market capitalization of the index. So what that means is, 490-ish other stocks that represent 60% of that of the value of that index. And in practice, what that means is you have a very small number of stocks that have carried that index, but should that momentum shift in, NVIDIA and Apple and Microsoft and Amazon and Alphabet and all these companies that we know and Meta, if they don't generate the kind of returns that they have in the past few years, then this idea, at least on the equity side, that you could just buy the S&P 500 and set it and forget it, that's going to change. And so, and that's something that we kind of saw, and what we've seen this year is that, those larger cap technology names have been a little bit more challenging this year than they were for sure last year, and you're seeing some rotation into other markets. So when we talk about fragility, that's really the big thing, is just that this concentration in the equity markets of just these big companies. And And if they go the wrong way, it drags the entire index down with them, which means that maybe 100% passive investing in that index is not the best approach.
Yeah, I mean, I have to say, just as a casual investor who manages a significant portion of his portfolio by himself, the numbers in the stats that you just mentioned are always on my mind, and they always make me really, really uncomfortable. And candidly, you've addressed part of my thinking in recent podcasts where you've really made an effort to delve into alternative investments and look outside of stocks and bonds, as it were. I mean, is that the gist of the conversation you're having with your clients who come to you and sort of express the same sentiment of, like, it's been fun, but at some point, does this party have to end?
Yeah, and I think that what you want is there's always been a thought, at least in recent history in this business, the last 20, 25 years or so, that your bonds alone, your fixed income was a diversifier. And that had been the case really leading up to about 2022 or so. But if you go back and look at further cycles back in history, you've had more correlation between stocks and bonds than most people really think,
Mm.
from a gut level. The recency bias in terms of what bonds and stocks have done relative to each other has been pretty it's really driven, I think, this idea that bonds alone are diversifying you. And we found for real in 2022 that they don't. And so you're trying to think of other ways. What are other asset classes? What are other investments that we can get into that truly are acting differently, and in a way that's uncorrelated with what's happening in just the S&P 500 or the aggregate bond index are those big measures of those giant markets.
Yeah, yeah, that is true. Well, on a non-market perspective, we have had a lot of things going on. We had a change in administrations.
We did. Yep.
President Trump is now firmly, decidedly in control of things. And, depending on who you believe, the tariffs are the best idea or the worst idea that ever happened. You don't have to have a position on it to understand that it's incredibly controversial and people are screaming on both sides of this. Does any of that factor into anything that you're looking to in 2025, or, clouding or coloring your judgment?
Yeah, I think it does because I think that it's a couple things. Is first, I think what Trump uses, I think he's fundamentally in favor of tariffs. He's been pretty
Right.
clear on that. But the interesting thing with him with some of these tariff threats, specifically, you're thinking obviously Canada and Mexico, and of course China to a lesser extent, at least in what he's threatened Canada and Mexico with, is for him to put that threat out there. It's kind of win-win because if those countries don't comply with what the United States wants, particularly around securing the border was really what it was with Mexico and also to a
Right.
lesser extent Canada, then he puts his tariffs in place and generates some revenue for the federal government, or they capitulate, which is what happened the last time, and he gets what he wants. Where you have 10,000 Mexican troops now that are at the border helping that stop that inflow across the southern border. So it is kind of a win-win for him. I do think that the tariff question, what you are seeing with President Trump, whether you like him or not, and it's not a political comment on him, it's a political comment on him, but it's not necessarily a personal comment on him, is you saw this when he was in power the first time, and I think you're seeing it again. He does recognize the amazing amount of power that this country does exercise,
Yes.
specifically over our smaller neighbors here. And the Colombia situation is a great example of that. You had the president of Colombia that was, going crazy, saying we're not going to take these people back that were in the United States illegally, and within a second he could snap that economy in two. So it's this idea that the United States needs to necessarily acquiesce to a country like Colombia, which has been down there twice. It's a magnificent place with great people. Not a comment on that, but we are truly the elephant in the room, for sure, in our hemisphere. And I think that he exercises that power in a very kind of in a way that I think that most people they can't. You don't really know what he's thinking or what he's doing, and I think that degree of uncertainty around his actions, like it makes him makes his threats a little bit more realistic, if that makes sense.
No, it does. It does. How do you answer your clients when they ask you? Because Trump's logic on the tariffs
Yeah.
is that, hey, you know what? I'm imposing these tariffs, and in this case, I'm thinking in my mind, in particular, about the aluminum and steel tariffs.
Yep.
And he's saying, hey, if you don't want to pay these tariffs, then build here, do here,
Yep.
create here. What I think a lot of people don't realize, and maybe you can give some perspective to this, is that weirdly, this is what Reagan did when he came into office in his first term, specifically with Japanese automakers, where
Yeah.
he slapped huge tariffs on them and said, if you don't want these tariffs, then put your factories here and build your cars here,
Yeah.
which is what they did. So, I mean, it worked.
Well,
Um,
this is an area. This is interesting because the way that my own belief system, particularly economically, has evolved. I'm 51 now, say versus when I was 25, has been pretty massive. I mean, when I was in my 20s, I was an absolute free market libertarian, almost not quite an anarchist, but pretty darn close. And and I don't necessarily believe that anymore because you drive through some of these towns that were formerly mill towns, that were formerly industrial towns, all through the Midwest and through the East, and they're totally gutted, you know.
yeah.
And I think that if that what we've done really since 1990 or so, we put NAFTA in place, and of course with the World Trade Organization, everything else, is the companies, and many of these the companies, and I think also our politicians have destroyed the fabric of our own economy, or at least or promoted at least that happening by cutting a couple percentage points here and there, or in favor of maybe a greater equity price because your profitability is higher. But what good is that if the nation gets hollowed out? So that's an area where I've dramatically shifted because I think that you can't this notion. I know that I think Obama very famously said that to these industrial workers or the coal miners or folks that were put out of business because the factories up and went and moved away. Well, we'll teach them all the code. Well, you're not going to do that, and I think that if you're a guy and you're working in the coal country in West Virginia or Pennsylvania or someplace like that, and your entire life you were making a really good living, and then suddenly now you can't. That creates despair, creates a lack of ownership in your own community, in your own economy. So who really, quite frankly, not about being blunt about it, who gives a damn if you can go and buy, some crappy goods at Walmart for 5% cheaper? It doesn't. Like, who are you really helping?
Hmm.
And so I think that's an area where I think I've become. You could even use the term a little bit more protectionist in the sense that you've got to take care of your family first. I think the moral obligation that any human being has, you got to take care of yourself, because if you're not okay, you can't take care of those around you. Then you've got to take care of your family ahead of anybody else. Then you've got to take care of your community beyond that, and then maybe beyond your community, your state, and then your country. But the allegiance has to be the people of this country, and it's not to gross domestic product growth, or it's not
Hmm.
to the profitability of pick a manufacturer. It's got to be to the people of this country, and that's an area where I think I've changed a little bit. So when I hear him talk about some of that protectionism, I don't necessarily really like that term, but I think, okay, if that puts incentives in place where in the past we've had massive incentives to move stuff out of here. But if that puts incentives in place for people to come back here and build factories back here and put Americans back to work, I'm generally for that.
No, no, and I kind of echo your transformation personally as well. I've done a lot of stories. When I was a reporter, I did a lot of stories on these hollowed out communities, and
Yeah.
I've seen it firsthand, and I understand the devastation, and I understand the despair that it wrecked in a lot of places. But as I was reminded doing these stories, and as I remind myself all of the time now, the truth is that it is a global economy, and the
Yeah,
people who want to
absolutely.
point that out are not wrong. They're not wrong. It's a question of balance, right?
Yeah, and it's not to say that you can't be trading around the world and purchasing goods from around the world, but if you have another country that's imposing 200% tariffs on our own products, or
Hmm.
like the Chinese are famously doing, using government funds at their level to subsidize their production to make them artificially cheap relative to our goods, then that's not a level playing field. So I would almost be more in favor of something. It's like, okay, you know what? If we have full access to your markets, then great, we can do that here. But you know what? We're not going to give you full access to the U.S. market if we get nothing close to that on the other side of it. It has to be a level playing field. And so, when I talk about perhaps some of those tariffs or some of that reshoring, or some of those protectionist measures being important for the country, you can take that too far and you can essentially become like the old Soviet Union, where you have the state
Right.
is either using law or they're using regulations or they're using lack of outside trade to protect industries that quite frankly don't deserve to be protected. And I do think when you look at what you saw with some of the manufacturing and industrial base we had in this country, it was ripe to get picked off by other countries because it was aging, it was growing old. We were not innovating the way that we had in the past, which I think is changing radically now, by the way. And so, yeah, of course, if those businesses aren't competitive anymore, then they should be under pressure from the global economy to innovate and do better. But I don't think you should subsidize your economic opponents to make it easier for them. I guess that's my key point.
No, no, no. I think it's a great point. It's an
Yeah.
excellent point. You know, speaking of things that are not yet happening, as tariffs, we've got the threat of, and in some cases, the imposition of. One of the big things that's going to happen in 2025, and I have no idea what this is going to look like, is the Jobs Cut and Tax Act expires at the end of this year.
Right.
That could have, if they expired, massive consequences, Brent.
It could, and particularly there's issues all the way down the line, but particularly around estate taxes. So right now, you have a married couple that has built a fairly successful business or a lot of wealth, and they've got the current exemption is, I'm looking at the list right now, is 27.22 million per married couple. That drops to 13.6 million. So that basically gets cut in half, which means that folks that may have not necessarily had to do any significant estate tax planning if they were sitting at 15 or 20 million dollar net worth now have to think about this again. So that is a big one. And you've got obviously individual tax rates would be looking to go up from about 37 to 39.6. Capital gains and dividend taxes could go up. Business tax rates, I think that's a really big one. They could also be heading higher as well. We were chatting a little bit offline before we started recording here about this, and I don't think that this thing in its entirety expires. I think that there's too
Right.
much political momentum right now that the Trump administration does have to not get something through. I think it's just a question of what it's going to look like.
Yeah, that was actually my next question. Is it going to look the same, or do you think it's going to have some sort of? I'm not asking you to guess what kind of modifications,
Yeah.
but do you think it's probably going to have some modifications in it?
Yeah, I think there's probably got to be some political give and take all the way around. I mean, the majority that the Republicans do have, at least in the House, is pretty slim. It's historically slim. It's a couple seats. So you're gonna
Exactly.
you're gonna have to give something. I think the one that I would probably care about the most would be that corporate tax rates for sure, but also the estate tax. The estate taxes, the exemption dropping that precipitously, because that's always been one that I've taken issue with, in the sense that so many of the people, your uber wealthy, super wealthy people, they have the resources, they can get the attorneys, they can structure their businesses and their life in a way that they're really not going to get ensnared by that. The thing that the estate tax hammers is the farmer who maybe the family makes barely enough to kind of keep the farm going, but they're sitting on an enormous piece of real estate, or a rancher,
Right.
same thing. You see it out here in the West all the time, where you've got, like a cattle operation running out here in the West on 10 grand, on 10,000 acres. You might net maybe 75, 100 grand from running cattle on that, maybe. In many of these cases, it's the hunting rights, depending on what state they're in, that they're leasing those out to outfitters. It's more profitable than the cattle, but they're sitting on a piece of property worth 25, 30, 40, 50 million
Yes.
dollars. And so what can you do? You can either you got to sell it, or a piece of it, to take care of that. And we had, famously out here, you see that in Arizona a lot, with some bigger chunks of the land that when people die, that ends up getting broken apart. So it happens to farmers, it happens to ranchers, it also happens to, I think, to smaller businesses. It's not happening. The super wealthy Bill Gates this is not a concern for him, or Zuckerberg or Bezos. I mean, they've created their family foundations. They've gifted all their money into the family foundations. They put everybody in the family on payroll, making hundreds of thousands of dollars a year, and they're paying no estate tax. I mean, that's just what Warren Buffett, same thing. And so it's not impacting them, but it is dramatically impacting people that to look at them, you would not think that they are super rich, because from a cash flow perspective, they're not. From a liquidity perspective, they're not. But they've got this enormous valuable asset that ends up being subject to a forced sale to try to meet that estate tax. And that, to me, is kind of tragic. And you see that happen repeatedly. And so that's kind of the big one that I'd like to see them address that, and hopefully make some carve outs there where you're not going to hurt the people that, quite frankly, I think you shouldn't be hurting with an estate tax.
Yeah, no, it's a really good point. Very well made. One of the things that we are seeing happen, I don't know how long we're going to see it happen. Personally, I hope it goes on for quite some time. But, Doge,
Yeah,
lots of Doge talk. And,
this
and
has been
I have people who like
fascinating.
come to me. It is fascinating. I have people come to me and they're all outraged. And I'm like, are you aware that the national debt, we have 120% or greater
Yep.
of GDP? And they look at me like I've got four eyes. And I'm like, we owe more money than we make. We owe
Yeah.
way more money than we produce economically every year. We have to cut. I would imagine your clients are kind of curious about whether they support it or not. Like,
Yeah.
hey, well, what's going on here?
I think I think that this is really interesting because what I have what I've gotten from speaking with clients, and some clients I know politically where they are on the spectrum. They might be, love Trump or they hate Trump, or because he's a very polarizing guy. It's kind of there's no real middle ground with him.
No,
And
there's
again, this is
not.
not a comment for or against him, but what I have found is almost without exception, there's been a few exceptions, that the folks that I'm talking to, regardless of where they fall on the political spectrum, they are not necessarily having a problem with lifting the hood here and seeing where some of these dollars are going. And I think that, in fact, I was a family member of mine who is a very liberal Democrat. And we were chatting the other night, and he's like, all this stuff they're uncovering almost makes me an independent. Did not vote for Trump, by the way. Doesn't like Donald Trump, but is now looking at this and saying, wait a second, you know what? Like, I'm thinking about every dollar that I'm spending here, and meanwhile, we're spending billions and billions and billions of dollars that essentially looks like a money laundering operation. I mean, it doesn't even look like true, like the USAID stuff. It doesn't look like aid. It looks like a giant money laundering operation. Now, whether that's true or not, we're going to find out. But I think that's pretty interesting, and that the Doge thing, if that comes to fruition, and I know that they've expressed a target, Musk and Trump, of trying to cut $2 trillion out of the budget within 2 years. And if they do that, that could potentially change what our view is on interest rates. Because again, the other fragility piece, I talked about those three sort of themes that we have. And in
Yeah.
that fragility piece is, we think that, again, this has been passed, this has come to fruition as well. We think that inflation rate's a little stickier than people think. The Fed's targeting 2%. We're still coming in the mid threes, which historically, that's where we were through most of the 80s, but it's not where the Fed is trying to get to, which means that those cuts may not happen. And I think some of the bond traders are pretty smart, and they're keeping those rates higher. We're well into the fours. So I think those rates could be sticky, and inflation could be sticky for longer, unless suddenly they do cut for $2 trillion worth of spending. And that, by its very nature, would be disinflationary, because now you don't have to have the money supply creation to support the debt, because we are a debt-based currency. So the more debt we create, the more money you're throwing out there in the system, and eventually it gets into where I think we're close to now, getting like not a really good parabolic spiral here. But if they're able to put the brakes on this, and truly for the first time in history get cuts, because we've never had cuts. We've had some cuts in the rates of increase, but we've never actually had true cuts.
Right.
And if they can do this, I think it's going to be pretty interesting. And I do think that the politicians on both sides of the aisle, because you've seen it with some, some Republicans that I would call them more sort of, you know, like uniparty type Republicans, and you've seen it with the Democrats that are coming out very vocally against looking at these spending programs. I don't think that's selling well with the American people. I think the American people are, for lack of a better term, kind of pissed at where their money's going. Now,
I find it weird.
yeah,
I just forget where you fall on the political spectrum. I don't care. I think it's weird that you don't want to know where money's being spent. I can't even grasp it. I mean, how do you get a handle on your talking to you now as a financial planner? How
yeah.
do you even get a handle on your finances if you have no idea where your money's going?
Well, I think what's so insulting to the American people is you can't come back to a government agency or the Internal Revenue Service and say, "Oh, I don't really know where that went." That's unacceptable. They want to know where every single dollar that you're spending is going, and and have an enormous amount of power to make sure that you do that. But on the same point, the Pentagon has failed audits for years and years and years, and all these massive, all these
Seven audits.
seven
Seven
audits,
audits for those of you listening. They have
and this is
failed seven audits.
and this is $1 trillion that the Pentagon gets every single year. You failed seven audits. In what other world is that level of lack of accountability. That lack of accountability. Where else is it acceptable? And why should it be with that essentially are taking our money? I mean, it is our money, and I think that that's the fundamental shift between, here's some of these politicians that are coming out and saying, they're talking about their money and the government money, and no, it's not your money. You're taking you're taking what you want from the American taxpayer, and there's got to be, that's a two-way street. We've got an obligation to our country. You've got an obligation to be a good citizen. You've got an obligation to pay your taxes and to follow the letter of the law. But you know what, man, that obligation goes both ways. And if you're demanding transparency from the American people, which in every single way, I mean, the American people are an open book. Every single piece of data about us is out there. If you're demanding that level of transparency from us, then you damn well better give it up yourself. And I think
Totally.
that people are seeing that, and I think that's one of the reasons this has been so interesting.
Yeah. What else are you? My mind is just brimming with a
There's
with a
so much
million
stuff going on. I
thoughts.
mean,
There's just so much going on.
yeah.
What else is it that you're addressing with your clients, Brent?
The big thing, so we made a lot, as any of the listeners that are listening to this podcast that are clients, you have definitely seen an enormous amount of adjustments and changes in our portfolios in the last month or so. And there's been a big push. Obviously, we've diversified out of just large cap U.S. You're still going to own it, still a core holding for sure, but there's not as much of it, and a lot more diversification or investment in particularly international markets. And international markets, we had small sleeves of that in place before, and during client reviews, it was almost a four-letter word because international markets just we have been in the longest stretch of underperformance of international markets, or the flip
Yeah.
side of that is outperformance of U.S. markets ever. You got to go back decades for that. And what you found then is that on a relative basis, U.S. stocks compared to international stocks, be that emerging markets, be it developed international, think Europe, Japan, Korea, that spread is at historic levels. I mean, you've got to go back decades and decades to find where, on a relative basis, U.S. stocks are so expensive versus international counterparts. So we've had a big push into international. So far this year, again, we're 6 months into the year, or excuse me, 6 weeks into the year, so we're very new. That's proven to be good. You have international markets are outperforming the S&P 500 almost a double. S&P's up about 3% or so. International stocks are up 7 and change, I think, since as we're recording this.
Wow.
And so that's been good. We also increased our exposure pretty dramatically this year to small cap stocks because again we're at historic valuation discounts for small cap stocks versus their large cap counterparts. And so far, year to date, that's been a pretty good place to be as well. And depending on what we see with onshoring and maybe some of these tariffs do come up, and maybe you do see more manufacturing occurring back here, and all the small businesses that have to pop up around that to support that, to build that ecosystem, that could be a positive thing that occurs as well. So that push in international has been pretty, so far anyway, has been pretty good, and so that's an area that we're looking as well. Even bonds, we talk a lot about alternatives on this show, but bonds, the one thing that the last couple of years have done is you're actually getting a rate of return now. You can actually get paid a real amount of money to hold a good fixed income portfolio. And so the bond exposure that we have, again, I'm not really a guy, we don't want to go out there 10, 15 years in terms of maturity, but I don't think the risk reward is there for that in case inflation is a lot stickier than we think. But in the short term, the inflationary pressures, if they do continue, is really not hurting the bond market if you're in the shorter end of the yield curve. And so that's an area that we've got quite a bit of focus as well, is in the fixed income portfolios, and what's the best way we can manage those.
Fantastic. Well, as we're getting near the end of this particular episode, is there anything you want to add to this, and by way of wrapping it up, or is there something else we need to touch on?
No, I think that again, in the last piece, we talked a little bit about durability, and for us, durability is incorporating the fixed income and asset classes that are cheap, which we think small cap international markets are cheap. And this thought of the age of alpha, which we put a label on it. And to us, it's, all right, what are the alpha generators? Where could you potentially get some excess return? And that's really thinking, okay, there are certain places, large cap U.S. stocks, for example, where you can buy that index. You can buy the S&P 500, and those funds are 4 basis points. I mean, it's ridiculously inexpensive to get exposure to that. And so why pay? And it's generally works. So why pay for an active manager? Because you've got to pay those teams to do that. But active management, where we think you can generate a little alpha, I think would be in some of those more fragmented markets. So emerging markets, equities, for example, international equities for sure, small cap. We think it's worth paying the managers there, and for sure going into alternatives. I mean, a downside of these alternative investments, and we consider them alpha generators as well, is that they tend to be more expensive. You know, the management fees and the charges associated with those. They add some weight in terms of costs to the portfolios. But again, the question is we're happy to pay it, and our clients are generally happy to pay it, provided that you're getting something greater than that in terms of excess return. And so that's kind of our three themes would be, again, that fragility, that durability, and that age of alpha. But I think that the overall mindset, though, for 2025, to try to put a bow on this, is that diversification beyond the S&P 500, I think, is important. You're not going to get rid of all your exposure to the S&P, but that the reliance that the S&P has right now on those mega caps, I think, is a little bit risky. Using fixed income and alternatives as stability anchors in the portfolio, if you're looking the right place specifically in both those asset classes, I think is very important. And being real selective with active versus passive investing. I mean, there's certain places it does not make any sense to pay an active manager. There are certain places where it does make some sense to pay an active manager to run that sleeve. And so being very selective in terms of where you're putting those dollars, I think, is important. But I think, the other thing is you got to stay flexible. And that's the one thing that we've chatted with clients this year, because we've really cut back some positions that have worked very well for the last couple of years, and it's like, well, it's really worked well, so why are we cutting this back? And it's because it worked yesterday, it doesn't mean it's going to continue to work tomorrow. And I think you got to stay flexible, because to our point, there is so much happening in the world right now. And to the original comment that I made about the fact that no one has a crystal ball, and this world that we live in is too dynamic. There's too many changes. There's too many things happening for anyone to realistically to give an accurate price prediction. Now you can look at the data that's out there and see on a relative basis, which assets are cheap, which assets historically are expensive. Those imbalances can persist for a really long time, but there's enough data to say, okay, at some point you're going to get reversion to the mean. Now, is it 5 years from now, or is it 5 weeks from now? You don't know. But I think you got to stay flexible, because I do think that, particularly with this government coming in, love or hate Donald Trump. Again, not a comment about him personally, because talk to people every day. Some people love the guy, some people hate him. But what we are seeing here is, at least in the first couple weeks of this administration, this is truly kind of a transformative era. Now, whether you like that transformation or not remains to be seen. But they are coming in there and actually addressing things within government that no one would have touched in the past. And you're talking about a $6 to $7 trillion spending apparatus, or wealth distribution apparatus, is really what the federal government has become. And if you cut a trillion out of that, or a couple trillion like they're talking about, the downstream effects of that, the ripple effects of that, it could be things that we don't even know. And I do think if they do cut some of that money, I think in the short term there could be a lot of pain, because now that money's flowing into the economy somehow, even if there's enormous fraud and waste, it's still getting somehow into the economy. You cut that out, that money's not going to be there right now. But I think in the long term, it's absolutely necessary to cut some big numbers from federal spending. But in the short term, you've got a system that is almost addicted to these federal dollars, and so there's going to be some withdrawal that the economy is going to deal with if all of a sudden you take away the main player in our economy right now. So what the downstream effects are of all that, if they can even do it, all remains to be seen. But it's one of the things that I love about this business and about what we do is it's never boring, because the set of data points in the world and everything that you're looking at, it's never the same. It's just history rhymes. History rhymes. It doesn't repeat, but it rhymes. But you never know exactly how that tune is going to get played out. That's for sure.
No, it is fascinating. This is a really, really interesting conversation. For people who are listening to this conversation who would like to have a little bit more of it, maybe reach out to you and talk to you. How do they get a hold of you?
Yeah, our number in here is on 602-255-0555. Member of the team will answer, and then they have pretty much every conceivable way to get a hold of me. TWS.finance is our website, and that has, again, all of our contact information. Really active on LinkedIn, and so if you message me on LinkedIn, it is me on the other side that will be messaging back. So happy to discuss any of these points in further detail if anybody's curious to talk about them.
You mean you don't have a bot that handles your responses on
I
LinkedIn?
do not have a bot that handles my responses. Not yet, anyway. Not yet.
And for those of you who are listening to this podcast who aren't subscribers, why not? That's really easy. All you have to do is reach out and hit the follow button. And as a subscriber, you're automatically notified every time Brent drops a new episode, and you can listen to it. It really is that simple. The one thing I would ask is if you like this podcast, if you find it interesting, informative, challenging, just plain entertaining, share it with people, tell people about it. Let people know, because word of mouth promotion is a tremendous and effective tool, and we would very much appreciate it. Until next time, I'm Bill Tucker on behalf of Brent and everybody at TWS. Thank you for taking the time to listen today. And do remember that you can today go out and make today a great day. Or not. The choice is yours. Use it. Until next time.
Thank you for listening to Smart Money Simplified. Have questions about topics covered during the show? Visit our website at www.smartmoneysimplified.com or give us a call at 602-255-0555. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of the wealth stewards or concurrent investment advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.